Risk management and insurance. Risk management and insurance are two interconnected concepts that are essential in protecting individuals, businesses, and organizations from the financial consequences of unexpected events. Risk management is the process of identifying, assessing, and managing risks to minimize the negative impact of uncertain events. It involves identifying potential risks, analyzing the likelihood and severity of their impact, and implementing strategies to reduce or mitigate the risks. The goal of risk management is to minimize the likelihood and severity of potential losses and protect against the financial impact of unexpected events. Insurance, on the other hand, is a contract between an insurer and a policyholder that provides financial protection against losses caused by covered events. Insurance policies are designed to transfer the financial risk of certain events from the policyholder to the insurer. Policyholders pay premiums to the insurer, and in return, the insurer agrees to cover the costs of specified losses. The purpose of insurance is to provide financial protection and help policyholders manage their risk by transferring the risk to an insurance company. Insurance policies can cover a wide range of risks, including damage to property, injuries, illness, and death. Insurance policies can be purchased by individuals, businesses, and organizations to protect against potential financial losses. To put it simply, risk management involves identifying and evaluating potential risks, while insurance is a financial tool that safeguards against losses caused by specific events. Combining risk management with insurance can enhance the financial protection of individuals and organizations by effectively managing their risks. The implication of risk management and insurance. Risk management and insurance play a vital role in protecting individuals, businesses, and organizations from financial losses caused by unexpected events. Protection against financial losses. Risk management and insurance provide protection against financial losses that may occur due to unexpected events, such as accidents, natural disasters, or theft. Without insurance, individuals and businesses would be responsible for covering the costs of these losses, which could be financially devastating. Peace of mind. Individuals and businesses can feel more secure by having insurance coverage that protects them in case of unforeseen events. This can help reduce stress and anxiety, allowing individuals and businesses to focus on other important aspects of their lives and work. Compliance with legal requirements. Many types of insurance are required by law, such as workers' compensation insurance for businesses and auto insurance for drivers. Failure to comply with these legal requirements can result in fines, penalties, or legal action. Risk reduction. Through risk management, individuals and businesses can identify potential risks and take steps to reduce or mitigate those risks. This can help prevent losses from occurring in the first place, reducing the need for insurance claims. Business continuity. For businesses, insurance can help ensure business continuity in the event of a loss. This can help businesses recover quickly and continue to operate, minimizing the impact of the loss on the business and its employees. Risk management and insurance are crucial tools for safeguarding individuals, businesses, and organizations against financial losses and providing peace of mind. To manage risk and safeguard financial well-being, it's important for individuals and businesses to use reliable risk management tactics and have proper insurance coverage. Different types of risks. There are many different types of risks that individuals, businesses, and organizations may face. Financial risks. Financial risks are those related to financial losses, such as those caused by market fluctuations, currency exchange rates, interest rates, credit defaults, and inflation. Financial risks can be mitigated through diversification, hedging, and other financial strategies. Operational risks. Operational risks are those related to the operations of a business or organization, such as those caused by human error, equipment failure, system breakdowns, and supply chain disruptions. Operational risks can be managed through effective risk management practices, including process controls, training, and contingency planning. Strategic risks. Strategic risks are those related to the strategic decisions of a business or organization, such as those related to market competition, changes in industry regulations, and disruptive technologies. Strategic risks can be managed through effective strategic planning and risk analysis. Reputational risks. Reputational risks are those related to the reputation of a business or organization, such as those caused by negative publicity, customer complaints, and legal disputes. Reputational risks can be managed through effective communication and reputation management strategies. Legal risks. Legal risks are those related to legal or regulatory compliance, such as those caused by lawsuits, fines, and penalties. Legal risks can be managed through effective compliance programs and legal advice. Environmental risks. Environmental risks are those related to environmental factors, such as those caused by natural disasters, pollution, and climate change. Environmental risks can be managed through effective risk management practices, including disaster preparedness and environmental sustainability programs. Health and safety risks. Health and safety risks are those related to the health and safety of employees and customers, such as those caused by workplace accidents, product defects, and disease outbreaks. Health and safety risks can be managed through effective health and safety programs and risk assessments. There are many different types of risks that individuals, businesses, and organizations may face. Understanding these risks and implementing effective risk management strategies is essential for managing these risks and protecting against potential financial losses. Life insurance. Life insurance is a type of insurance that provides financial protection to the beneficiaries of the policyholder in the event of the policyholder's death. The beneficiaries are typically family members, but they can also be a business partner, a charity, or any other person or entity that the policyholder designates. There are two main types of life insurance: term life insurance and permanent life insurance. Term life insurance provides coverage for a specific period of time, usually 10, 20, or 30 years. If the policyholder dies during the term of the policy, the beneficiaries receive a death benefit payout. Term life insurance is generally less expensive than permanent life insurance, and it is a good option for those who need coverage for a specific period of time, such as until their children graduate from college or their mortgage is paid off. Permanent life insurance, also known as whole life insurance, provides coverage for the policyholder's entire life. In addition to the death benefit payout, permanent life insurance policies also have a cash value component. The cash value grows tax-deferred over time, and the policyholder can borrow against it or withdraw it to supplement retirement income or meet other financial needs. Life insurance is an important tool for financial planning, as it can provide peace of mind and financial security for loved ones in the event of the policyholder's unexpected death. It can also be used to pay for final expenses, such as funeral costs, and to pay off outstanding debts, such as a mortgage or student loans. When choosing a life insurance policy, it is important to consider the policy's coverage amount, premium cost, and any exclusions or limitations. A financial advisor or insurance agent can help determine the best type of policy and coverage amount for an individual's specific needs and financial situation. Health insurance. Health insurance is a type of insurance that provides coverage for medical expenses incurred by the policyholder. Health insurance can be provided by an employer or purchased individually by an individual or family. Health insurance policies typically cover a wide range of medical services, including hospitalization, surgery, doctor visits, prescription drugs, and preventive care. The specifics of the coverage vary depending on the policy, but most policies cover at least a portion of these services. There are several types of health insurance plans available, including HMOs, health maintenance organizations, HMOs require policyholders to choose a primary care physician who is responsible for coordinating all of their healthcare needs. HMOs typically have lower out-of-pocket costs, but offer less flexibility in terms of choosing healthcare providers. PPOs, preferred provider organizations. PPOs allow policyholders to choose from a network of preferred healthcare providers, but also provide coverage for out-of-network providers. PPOs typically have higher out-of-pocket costs, but offer more flexibility in terms of choosing healthcare providers. EPOs, exclusive provider organizations. EPOs are similar to PPOs, but typically do not provide coverage for out-of-network providers. POS, point-of-service plans. POS plans are a combination of HMO and PPO plans, allowing policyholders to choose from a network of preferred providers, but requiring them to choose a primary care physician. Health insurance is an important tool for managing healthcare costs, as it can provide financial protection in the event of a medical emergency or illness. Without health insurance, the cost of healthcare can be prohibitively expensive, potentially leading to financial hardship or bankruptcy. It is important to choose a health insurance plan that fits an individual or family's specific healthcare needs and budget. A healthcare insurance advisor or insurance agent can help navigate the complexities of choosing a health insurance plan. Property insurance. Property insurance is a type of insurance that provides coverage for the physical assets of the policyholder, including their home, car, and personal belongings. Property insurance policies typically cover damage or loss caused by a range of perils, including fire, theft, natural disasters, and other events specified in the policy. Homeowners insurance. Homeowners insurance provides coverage for a policyholder's home and personal property. It typically covers damage or loss caused by perils such as fire, theft, and natural disasters. Homeowners insurance may also include liability coverage for accidents that occur on the property. Renters insurance. Renters insurance provides coverage for a policyholder's personal property in a rented residence. It typically covers damage or loss caused by perils such as fire, theft, and natural disasters. Renters insurance may also include liability coverage for accidents that occur on the rented property. Auto insurance. Auto insurance provides coverage for a policyholder's vehicle in the event of an accident, theft, or other damage. Auto insurance may also include liability coverage for accidents that the policyholder causes while driving. Business insurance. Business insurance provides coverage for a policyholder's business assets, including property, equipment, and inventory. Business insurance may also include liability coverage for accidents that occur on the business premises or as a result of the business operations. Property insurance is an important tool for protecting an individual or business's assets from financial loss due to unforeseen events. It can provide peace of mind and financial protection in the event of damage or loss to property. It is important to choose a property insurance policy that fits an individual or business's specific needs and budget. An insurance agent or broker can help determine the best type of policy and coverage amount for an individual or business's situation. Liability insurance. Liability insurance is a type of insurance that provides coverage for damages or losses resulting from a policyholder's actions or inactions that cause harm to others. Liability insurance can be purchased by individuals, businesses, and organizations to protect against financial losses resulting from legal claims or lawsuits. General liability insurance. General liability insurance provides coverage for claims resulting from bodily injury or property damage caused by the policyholder or their products or services. It may also provide coverage for claims related to advertising or personal injury. Professional liability insurance. Professional liability insurance, also known as errors and omissions, E&O insurance, provides coverage for claims resulting from professional negligence or errors made by the policyholder. This type of insurance is commonly purchased by professionals such as doctors, lawyers, and accountants. Product liability insurance. Product liability insurance provides coverage for claims resulting from injuries or damages caused by a defective product sold by the policyholder. This type of insurance is commonly purchased by manufacturers, wholesalers, and retailers. Umbrella insurance. Umbrella insurance provides additional liability coverage beyond the limits of a primary liability policy. It can provide protection in the event of a catastrophic loss or lawsuit that exceeds the limits of the primary policy. Liability insurance is an important tool for protecting individuals and businesses from financial losses resulting from legal claims or lawsuits. Without liability insurance, the costs associated with defending a legal claim or lawsuit can be significant and potentially lead to financial ruin. It is important to choose a liability insurance policy that fits an individual or business's specific needs and budget. An insurance agent or broker can help determine the best type of policy and coverage amount for an individual or business's situation. Risk identification. Risk identification is the process of identifying potential risks that an individual, organization, or project may face. The goal of risk identification is to identify potential risks early on so that appropriate measures can be taken to mitigate or manage the risks. Brainstorming. This involves gathering a group of stakeholders and discussing potential risks that the individual, organization, or project may face. The group should consider various scenarios and potential consequences. Risk assessments. This involves reviewing historical data, industry trends, and other factors that may impact the individual, organization, or project. A risk assessment can help identify potential risks and determine the likelihood and potential impact of each risk. Checklists. This involves using a checklist of potential risks to identify potential risks that the individual, organization, or project may face. Checklists can be customized to the specific industry or project. SWOT analysis. This involves conducting a SWOT, strengths, weaknesses, opportunities, and threats analysis to identify potential risks and opportunities that the individual, organization, or project may face. Once potential risks are identified, it is important to assess each risk and determine the likelihood and potential impact of each risk. This information can be used to prioritize risks and develop appropriate risk management strategies. Effective risk identification is an important step in the risk management process. Identifying potential risks in advance allows individuals, organizations, or projects to take measures to mitigate or manage risks. This may decrease the likelihood and impact of negative consequences. Risk assessment. Risk assessment is the process of evaluating potential risks that an individual, organization, or project may face. The goal of risk assessment is to determine the likelihood and potential impact of each risk and prioritize risks based on their severity. Identify potential risks. This involves using various methods such as brainstorming, checklists, or SWOT analysis to identify potential risks that the individual, organization, or project may face. Evaluate the likelihood of each risk. This involves assessing the probability of each risk occurring. This can be done by reviewing historical data, industry trends, and other relevant factors. Evaluate the potential impact of each risk. This involves assessing the potential consequences of each risk. This can include financial, operational, reputational, or legal consequences. Prioritize risks. This involves prioritizing risks based on their severity. This can be done by assigning a risk rating to each risk based on its likelihood and potential impact. Develop risk management strategies. This involves developing appropriate risk management strategies for each identified risk. This may include avoiding, transferring, mitigating, or accepting the risk. Effective risk assessment is an important step in the risk management process. Assessing potential risks, individuals, organizations, or projects can develop appropriate risk management strategies and potentially reduce the likelihood and impact of negative consequences. Regular risk assessments should be conducted to ensure that new risks are identified and existing risks are properly managed. Risk control. Risk control is the process of implementing strategies to manage or mitigate identified risks. The goal of risk control is to reduce the likelihood and potential impact of negative consequences resulting from risks. Avoidance. This involves avoiding the activity or situation that creates the risk altogether. For example, a business may decide not to enter a particular market if the potential risks outweigh the potential benefits. Transfer. This involves transferring the risk to another party, typically through insurance or contractual agreements. For example, a business may purchase liability insurance to transfer the risk of a lawsuit to the insurance company. Mitigation. This involves reducing the likelihood or potential impact of the risk. For example, a construction company may implement safety protocols to reduce the risk of workplace accidents. Acceptance. This involves accepting the risk and its potential consequences. For example, a business may accept the risk of a market downturn and continue with its investment strategy. Effective risk control requires a thorough understanding of the identified risks and the potential consequences of each risk. It is important to choose appropriate risk control strategies that fit an individual, organization, or project's specific needs and budget. Regular monitoring and evaluation of risk control measures should be conducted to ensure that they remain effective and appropriate. Risk control is an important component of the risk management process. By implementing appropriate risk control strategies, individuals, organizations, or projects can potentially reduce the likelihood and impact of negative consequences resulting from risks. Risk financing. Risk financing refers to the process of identifying and implementing strategies to finance the potential costs of managing or mitigating identified risks. The goal of risk financing is to ensure that an individual, organization, or project has the financial resources necessary to manage or mitigate the negative consequences resulting from risks. Retention. This involves retaining the financial responsibility for managing or mitigating the risk. For example, an individual may choose to self-insure by setting aside funds to cover potential medical expenses. Insurance. This involves transferring the financial risk to an insurance company through the purchase of insurance policies. Insurance policies typically require payment of a premium in exchange for coverage of potential losses. Contracts. This involves transferring the financial risk to another party through contractual agreements. For example, a construction company may transfer the risk of delays or cost overruns to a subcontractor through a contractual agreement. Alternative risk transfer. This involves using alternative financial instruments to manage or transfer risk. For example, a company may use a captive insurance company or a risk retention group to self-insure against certain risks. Effective risk financing requires a thorough understanding of the identified risks and the potential financial impact of each risk. It is important to choose appropriate risk financing strategies that fit an individual, organization, or project's specific needs and budget. Regular monitoring and evaluation of risk financing measures should be conducted to ensure that they remain effective and appropriate. Risk financing is an important component of the risk management process. Implementing appropriate risk financing strategies, individuals, organizations, or projects can potentially ensure that they have the financial resources necessary to manage or mitigate the negative consequences resulting from risks. Risk monitoring. Risk monitoring is the ongoing process of tracking identified risks and evaluating the effectiveness of risk management strategies. The goal of risk monitoring is to identify any changes in the likelihood or potential impact of identified risks and to adjust risk management strategies as necessary. Regular review. This involves regularly reviewing identified risks and risk management strategies to ensure they remain current and effective. Tracking changes. This involves tracking changes in the likelihood or potential impact of identified risks, such as changes in the business environment, industry trends, or regulatory requirements. Evaluating risk management strategies. This involves evaluating the effectiveness of risk management strategies and making adjustments as necessary. For example, if a risk management strategy is not effective in reducing the likelihood or potential impact of a risk, it may need to be modified or replaced. Reporting. This involves reporting on the status of identified risks and risk management strategies to stakeholders, such as senior management, shareholders, or regulatory agencies. Effective risk monitoring requires a commitment to ongoing review and evaluation of identified risks and risk management strategies. It is important to have appropriate systems and processes in place to facilitate the timely identification and reporting of changes in risk status. Risk monitoring is an important component of the risk management process. Regularly reviewing and evaluating identified risks and risk management strategies, individuals, organizations, or projects can potentially identify and address new or changing risks before they have a negative impact. Avoidance. Avoidance is a risk control strategy that involves avoiding the activity or situation that creates the risk altogether. The goal of avoidance is to eliminate the risk entirely by not engaging in the activity or situation that presents the risk. Market risk. A business may choose to avoid entering a particular market if the potential risks outweigh the potential benefits. Credit risk. A lender may choose to avoid lending to borrowers with poor credit histories to reduce the risk of default. Operational risk. A company may choose to avoid implementing a new technology if the potential risks of implementation outweigh the potential benefits. While avoidance can be an effective risk control strategy, it may not always be practical or feasible. Avoidance may require significant changes to business operations and may result in missed opportunities or reduced profitability. Additionally, some risks may be unavoidable, and avoidance may not be a viable option. When considering avoidance as a risk control strategy, it is important to weigh the potential benefits and drawbacks, and to consider alternative risk control strategies that may be more effective or feasible. Effective risk management involves a careful balance of risk control strategies that are appropriate for the identified risks and the needs of the individual, organization, or project. Loss prevention. Loss prevention is a risk control strategy that involves taking proactive measures to prevent or reduce the occurrence of losses. The goal of loss prevention is to minimize the potential for losses by identifying and addressing potential sources of loss before they occur. Fire prevention. A business may implement fire prevention measures, such as installing fire alarms, sprinkler systems, and fire extinguishers, to reduce the risk of fire-related losses. Safety training. An organization may provide safety training to employees to reduce the risk of workplace accidents and injuries. Cybersecurity measures. An organization may implement cybersecurity measures, such as firewalls, antivirus software, and data encryption, to reduce the risk of data breaches and cyber attacks. Effective loss prevention requires a proactive approach to risk management. It is important to identify potential sources of loss and to implement appropriate measures to address them before they result in actual losses. Regular monitoring and evaluation of loss prevention measures should be conducted to ensure their effectiveness and to identify opportunities for improvement. Loss prevention is an important component of the risk management process. Implementing appropriate loss prevention strategies, individuals, organizations, or projects can potentially reduce the likelihood and severity of losses, resulting in improved profitability and sustainability. Loss reduction. Loss reduction is a risk control strategy that involves taking measures to minimize the impact of losses that have already occurred. The goal of loss reduction is to mitigate the effects of a loss, such as reducing the amount of financial loss or the duration of the loss. Business continuity planning. An organization may develop a business continuity plan to minimize the impact of an unexpected event, such as a natural disaster or a cyber attack. The plan may include strategies for backup systems, alternative work locations, and communication protocols to ensure continuity of operations. Emergency response planning. An organization may develop an emergency response plan to minimize the impact of an unexpected event, such as a workplace accident or a fire. The plan may include procedures for evacuating employees, contacting emergency services, and providing medical assistance. Insurance coverage. An individual or organization may purchase insurance coverage to minimize the financial impact of a loss. Insurance coverage can provide financial assistance for expenses related to property damage, liability claims, and other losses. While loss reduction cannot eliminate the occurrence of a loss, it can help to minimize the impact of a loss and improve recovery efforts. Effective loss reduction requires a proactive approach to risk management, including regular evaluation of risk management strategies and adjusting strategies as needed. Loss reduction is an important component of the risk management process. Implementing appropriate loss reduction strategies, individuals, organizations, or projects can potentially reduce the impact of losses, resulting in improved financial stability and sustainability. Transfer. Transfer is a risk financing strategy that involves shifting the financial burden of a potential loss to another party, typically an insurance company or a contractual partner. The goal of transfer is to mitigate the financial impact of a potential loss by transferring the risk to another party that is better equipped to absorb the financial consequences of the loss. Insurance coverage. An individual or organization may purchase insurance coverage to transfer the risk of potential losses to an insurance company. Insurance coverage can provide financial assistance for expenses related to property damage, liability claims, and other losses. Contractual agreements. An individual or organization may enter into a contractual agreement that transfers the risk of potential losses to another party. For example, a construction contractor may require subcontractors to obtain liability insurance coverage to transfer the risk of potential losses related to the subcontractor's work. Hedging. An investor may use financial instruments, such as futures contracts or options, to transfer the risk of potential losses associated with changes in market prices or other financial variables. While transfer can be an effective risk financing strategy, it may not always be the most cost-effective or feasible option. The cost of transferring risk may be high, and the terms of insurance policies or contractual agreements may not provide sufficient coverage or protection. When considering transfer as a risk financing strategy, it is important to weigh the potential benefits and drawbacks, and to consider alternative risk financing strategies that may be more effective or feasible. Productive risk management involves a careful balance of risk financing strategies that are appropriate for the identified risks and the needs of the individual, organization, or project. Retention. Retention is a risk financing strategy that involves accepting the financial consequences of a potential loss instead of transferring the risk to another party, such as an insurance company. The goal of retention is to minimize the overall cost of risk by retaining only the risks that can be effectively managed and transferring or avoiding risks that cannot be effectively managed. Self-insurance. An individual or organization may choose to self-insure by setting aside funds to cover potential losses instead of purchasing insurance coverage. Self-insurance can provide greater control over the management of potential losses, but it requires significant financial resources and the ability to accurately assess potential risks. Deductibles and co-payments. An individual or organization may choose to accept a portion of the financial burden of a potential loss by selecting a deductible or co-payment amount as part of an insurance policy. This can lower insurance premiums, but it requires the ability to pay the deductible or co-payment if a loss occurs. Risk retention groups. An individual or organization may choose to join a risk retention group, which is a group of similar businesses or individuals that pool their resources to cover potential losses. This can provide greater control over the management of potential losses and lower insurance premiums, but it requires a significant commitment of resources and a high level of trust among the members. Retention can be an effective risk financing strategy when the potential losses can be effectively managed and the cost of transferring the risk is prohibitively high. Nevertheless, retention also involves a greater level of financial risk and requires the ability to accurately assess potential risks and manage potential losses. Practical risk management involves a careful balance of risk financing strategies that are appropriate for the identified risks and the needs of the individual, organization, or project. Policy components. In the context of insurance, a policy is a legal document that outlines the terms and conditions of an insurance agreement between an insurer and a policyholder. A policy typically contains several key components that define the scope of coverage, the terms of the agreement, and the obligations of both the insurer and the policyholder. Declarations page. This is the first page of the policy and contains basic information about the policyholder, such as the name and address, and information about the insured property or person. The declarations page also includes information about the coverage limits, deductibles, and premiums. Insuring agreement. This section outlines the scope of coverage provided by the policy. It describes the risks covered by the policy, the types of losses that are covered, and any exclusions or limitations. Conditions. This section outlines the terms and conditions of the policy, including the obligations of the insurer and the policyholder. It typically includes information about the policyholder's duties in the event of a loss, the insurer's obligations to investigate and pay claims, and any limitations or exclusions. Exclusions. This section identifies specific risks or events that are not covered by the policy. Common exclusions include intentional acts, certain types of natural disasters, and pre-existing conditions. Endorsements. These are additions or changes to the policy that modify the terms of the agreement. Endorsements can be added to the policy at any time and are used to customize coverage to meet the specific needs of the policyholder. Definitions. This section defines key terms used in the policy to ensure that both the insurer and the policyholder have a clear understanding of the terms used in the agreement. Comprehending the components of an insurance policy is essential for policyholders to know what risks are covered and to avoid potential disputes in the event of a loss. It is important to carefully review all policy documents and to ask questions if anything is unclear. Policy exclusions. Policy exclusions are specific risks or events that are not covered by an insurance policy. These exclusions are typically listed in the policy's exclusions section and may vary depending on the type of policy and the insurance provider. Knowing policy exclusions is important for policyholders to know what risks are not covered by their insurance and to avoid any potential misunderstandings or disputes in the event of a loss. Intentional acts. Insurance policies generally do not cover losses that result from intentional acts, such as fraud, theft, or deliberate damage to property. War and terrorism. Many insurance policies exclude coverage for losses caused by acts of war, terrorism, or political violence. Natural disasters. Some policies exclude coverage for certain types of natural disasters, such as earthquakes or floods, or may provide coverage only for an additional premium. Pre-existing conditions. Health insurance policies may exclude coverage for pre-existing medical conditions, or may limit coverage for those conditions. Wear and tear. Property insurance policies typically do not cover damage that results from normal wear and tear or lack of maintenance. Illegal activities. Insurance policies generally exclude losses that result from illegal activities, such as drug trafficking or other criminal acts. Policy exclusions are an important aspect of insurance policies and can significantly impact the coverage provided. It is essential for policyholders to carefully review their policy documents and ask questions if anything is unclear. In some cases, additional coverage may be available through endorsements or separate policies to address excluded risks. Policy limits. Policy limits refer to the maximum amount of coverage that an insurance policy will provide for a specific type of loss. Policy limits are established by the insurance company and are typically set at the time the policy is purchased. Recognizing policy limits is important for policyholders because it can help them to determine whether they have adequate coverage for potential losses. Liability coverage. Liability insurance policies typically have a per-incident limit and an aggregate limit. The per-incident limit is the maximum amount of coverage provided for each individual incident or claim, while the aggregate limit is the total amount of coverage provided for all incidents during the policy period. Property damage coverage. Property insurance policies may have separate limits for different types of property, such as buildings, personal property, or business equipment. The policy may also have a limit on the maximum amount that will be paid for a single loss. Life insurance coverage. Life insurance policies may have a fixed death benefit amount, which is the maximum amount that will be paid out in the event of the insured's death. Health insurance coverage. Health insurance policies may have separate limits for different types of benefits, such as hospitalization, prescription drugs, or medical procedures. The policy may also have a maximum out-of-pocket limit, which is the maximum amount that the policyholder will be required to pay for covered services during the policy period. Appreciating policy limits is important for policyholders to ensure that they have adequate coverage for potential losses. It is also important to periodically review policy limits to ensure that they are still appropriate given changes in the policyholder's circumstances or the value of insured property. Policy deductibles. Policy deductibles refer to the amount of money that a policyholder is responsible for paying out of pocket before their insurance coverage begins to pay for a loss. Policy deductibles are established at the time the policy is purchased and are typically expressed as a fixed dollar amount or a percentage of the total loss amount. Comprehending policy deductibles is important for policyholders because it can help them to manage the cost of their insurance premiums and to plan for potential losses. Property damage coverage. Property insurance policies may have separate deductibles for different types of property, such as buildings, personal property, or business equipment. The deductible amount is typically expressed as a fixed dollar amount, such as $500 or $1,000, or as a percentage of the total loss amount, such as 1% or 2%. Health insurance coverage. Health insurance policies may have separate deductibles for different types of benefits, such as hospitalization, prescription drugs, or medical procedures. The deductible amount is typically expressed as a fixed dollar amount, or as a percentage of the total cost of the benefit. Auto insurance coverage. Auto insurance policies may have separate deductibles for different types of coverage, such as collision or comprehensive coverage. The deductible amount is typically expressed as a fixed dollar amount, such as $500 or $1,000. Policy deductibles are important for policyholders because they can affect the cost of insurance premiums and the amount of coverage provided for a loss. In general, policies with higher deductibles have lower premiums, but may require the policyholder to pay more out of pocket in the event of a loss. Policyholders should carefully consider their financial situation and risk tolerance when selecting a deductible amount. Policy endorsements. Policy endorsements refer to changes made to an existing insurance policy that modify or add coverage to the policy. Endorsements are typically used to accommodate changes in a policyholder's circumstances or to provide coverage for risks that are not included in the standard policy. Endorsements are also known as riders or add-ons. Policy endorsements can be added to a policy at any time, but typically require the policyholder to pay an additional premium for the added coverage. Additional insured endorsement. This endorsement adds a person or organization as an additional insured to the policy. For example, a contractor may add a property owner as an additional insured on their liability insurance policy. Umbrella endorsement. This endorsement provides additional liability coverage beyond the limits of the underlying policy. Umbrella policies are commonly used to provide additional protection for high net worth individuals or businesses. Scheduled property endorsement. This endorsement adds specific items of valuable property, such as jewelry, artwork, or antiques, to the policy and provides additional coverage for these items. Earthquake endorsement. This endorsement provides coverage for earthquake damage, which is typically excluded from standard property insurance policies. Flood endorsement. This endorsement provides coverage for damage caused by floods, which is typically excluded from standard property insurance policies. Policy endorsements are important for policyholders because they can help to ensure that they have adequate coverage for their specific needs. Policyholders should review their policies regularly and consider adding endorsements if their circumstances change or if they need additional coverage for specific risks. It is also important to understand the cost of endorsements, as they may increase the overall cost of the policy. Claim filing process. The claim filing process is the procedure that a policyholder must follow when they experience a loss and wish to file a claim with their insurance company. Notification. The policyholder should notify their insurance company as soon as possible after the loss occurs. The notification should include a detailed description of the loss, including the date and time it occurred, the cause of the loss, and any injuries or damages that were sustained. Documentation. The policyholder should gather any documentation that supports their claim, such as receipts, photographs, police reports, and witness statements. This documentation should be submitted to the insurance company as part of the claim filing process. Investigation. The insurance company will typically conduct an investigation to determine the validity of the claim and the amount of compensation that should be provided. This may involve interviewing witnesses, reviewing documentation, and inspecting the damaged property. Payment. If the claim is approved, the insurance company will provide payment to the policyholder. The payment may be a lump sum or a series of payments, depending on the nature of the loss and the terms of the policy. Appeal. If the claim is denied, the policyholder may have the option to appeal the decision. This typically involves providing additional documentation or arguing the case before an appeals panel. It is important for policyholders to understand the claim filing process and to follow it carefully in order to ensure that their claim is processed in a timely and effective manner. Policyholders should also be aware of their rights and responsibilities under the policy, and should consult with their insurance company or a qualified attorney if they have any questions or concerns. Claim investigation. Claim investigation is the process by which an insurance company evaluates a claim made by a policyholder in order to determine the validity of the claim and the amount of compensation that should be provided. Gathering information. The insurance company will gather information about the loss from the policyholder, witnesses, and any relevant documentation, such as police reports, medical records, and repair estimates. Examining the evidence. The insurance company will carefully examine the evidence to determine whether it supports the policyholder's claim. This may involve reviewing photographs, conducting site visits, and consulting with experts, such as engineers or medical professionals. Evaluating coverage. The insurance company will review the policy to determine whether the loss is covered under the terms of the policy. If the loss is covered, the insurance company will determine the extent of the coverage and any deductibles or limits that apply. Assessing damages. The insurance company will assess the damages resulting from the loss and determine the amount of compensation that should be provided. This may involve estimating the cost of repairs or replacement, or evaluating the value of lost property or income. Communicating with the policyholder. Throughout the investigation process, the insurance company will communicate with the policyholder to keep them informed of the status of their claim and to request any additional information or documentation that may be needed. The goal of the claim investigation process is to ensure that the policyholder receives the compensation they are entitled to under the terms of their policy. The investigation process is often complex and may take some time to complete, but it is an important part of the insurance claims process. Policyholders should be prepared to provide accurate and complete information to the insurance company and should cooperate with the investigation to ensure that their claim is processed as quickly and efficiently as possible. Claim evaluation. Claim evaluation is the process by which an insurance company assesses the validity of a claim made by a policyholder and determines the amount of compensation that should be provided. The evaluation typically involves a careful review of the policy terms, the evidence supporting the claim, and any applicable laws or regulations. Policy coverage. The insurance company will review the policy to determine whether the loss is covered under the terms of the policy. This will involve a review of the policy's exclusions, deductibles, and limits. Evidence of the loss. The insurance company will examine the evidence supporting the claim, such as photographs, police reports, medical records, and witness statements. This evidence will be used to determine the cause and extent of the loss. Evaluation of damages. The insurance company will assess the damages resulting from the loss and determine the amount of compensation that should be provided. This may involve estimating the cost of repairs or replacement, or evaluating the value of lost property or income. Applicable laws and regulations. The insurance company will also consider any applicable laws and regulations that may impact the claim. For example, in the case of a car accident, the insurance company may need to consider state traffic laws and insurance regulations. Comparative negligence. In some cases, the insurance company may need to evaluate the role of the policyholder and other parties in causing the loss. This is known as comparative negligence and may impact the amount of compensation that is provided. The goal of the claim evaluation process is to ensure that the policyholder receives the compensation they are entitled to under the terms of their policy. The evaluation process is often complex and may involve multiple parties, including the policyholder, insurance company, and any relevant experts. Policyholders should be prepared to provide accurate and complete information to the insurance company and should work with their insurer to ensure that their claim is processed as quickly and efficiently as possible. Claim settlement. Claim settlement is the final step in the insurance claim process, where the insurance company agrees to pay the policyholder for the damages or losses covered by the policy. The settlement amount is typically based on the results of the claim investigation and evaluation process. Once the insurance company has completed its investigation and evaluation of the claim, it will notify the policyholder of its decision. If the claim is approved, the insurance company will typically issue a settlement payment to the policyholder. The payment amount will depend on the policy coverage, policy limits, and any deductibles that apply. In some cases, the policyholder may need to sign a release form before receiving the settlement payment. This form confirms that the policyholder accepts the payment as full and final settlement for the claim and waives any further rights to pursue legal action related to the claim. If the claim is denied, the insurance company will provide an explanation of the decision and the policyholder's options for appeal. In some cases, the policyholder may be able to negotiate with the insurance company for a higher settlement amount or request an independent review of the claim. It is important for policyholders to review the settlement offer carefully to ensure that it is fair and covers all of the losses or damages that are covered by the policy. If the policyholder has any questions or concerns about the settlement offer, they should contact their insurance company and seek advice from an independent insurance professional or legal advisor. In brief, claim settlement is the final step in the insurance claim process, where the insurance company agrees to pay the policyholder for the damages or losses covered by the policy. It is important for policyholders to review the settlement offer carefully and seek advice, if necessary, to ensure that they receive a fair and reasonable settlement amount. Claim denial and appeals. Claim denial occurs when an insurance company rejects a policyholder's claim for damages or losses covered under their policy. The reasons for claim denial can vary, including inadequate coverage, policy exclusions, insufficient evidence, or policyholders' non-compliance with policy requirements. If a claim is denied, policyholders have the right to appeal the decision. The appeal process allows policyholders to challenge the insurance company's decision and seek a review of their claim. Review the denial letter. The insurance company will send a written letter explaining the reasons for the claim denial. The policyholder should carefully review the letter and understand the basis for the denial. Gather additional information. If the policyholder believes that the insurance company made an error or overlooked important information, they can gather additional documentation or evidence to support their claim. Contact the insurance company. The policyholder can contact the insurance company to discuss the denial and seek clarification on the reasons for the decision. Submit an appeal. If the policyholder disagrees with the claim denial, they can submit an appeal to the insurance company. The appeal should include any additional information or evidence that supports the claim. Review and decision. The insurance company will review the appeal and make a decision. If the claim is approved, the insurance company will issue payment for the damages or losses covered by the policy. If the claim is still denied, the policyholder can escalate the appeal process. Escalate the appeal. If the policyholder is not satisfied with the appeal decision, they can escalate the appeal process by requesting a review from an independent third party, such as a mediator, arbitrator, or state insurance commissioner. Claim denial can occur when an insurance company rejects a policyholder's claim for damages or losses covered under their policy. The appeals process allows policyholders to challenge the insurance company's decision and seek a review of their claim. Policyholders should review the denial letter, gather additional information, contact the insurance company, submit an appeal, and escalate the appeal if necessary. Cybersecurity risks. Cybersecurity risks refer to the potential harm or damage caused by attacks on digital information systems, networks, and devices. Cybersecurity risks can come from a variety of sources, including external attackers, internal threats, and unintentional errors. Malware. Malware is a type of software designed to harm or compromise computer systems. Examples of malware include viruses, trojans, worms, and ransomware. Phishing. Phishing is a social engineering attack where hackers send fraudulent emails or messages that appear to be from a legitimate source, tricking users into providing sensitive information or downloading malicious software. Password attacks. Password attacks involve hackers attempting to guess or steal user passwords to gain access to systems or sensitive information. Denial of service, DOS attacks. DOS attacks involve overwhelming a system or network with traffic or requests, making it unavailable to legitimate users. Insider threats. Insider threats refer to malicious or unintentional actions by employees, contractors, or other authorized individuals that can compromise information systems. To manage cybersecurity risks, organizations can implement a range of security measures, such as firewalls, encryption, access controls, and employee training. Regular testing and updating of security systems is also important to stay ahead of evolving cyber threats. Cybersecurity risks can come from a variety of sources and can cause significant harm to organizations and individuals. To manage these risks, organizations can implement a range of security measures, including firewalls, encryption, access controls, and employee training. Regular testing and updating of security systems is also important to stay ahead of evolving cyber threats. Climate change risks. Climate change risks refer to the potential harm or damage caused by the effects of global warming and the resulting changes in climate patterns. Climate change can cause a range of environmental, social, and economic impacts that can affect individuals, organizations, and communities. Extreme weather events. Climate change can lead to more frequent and severe weather events, such as hurricanes, floods, droughts, and wildfires. Sea level rise. As global temperatures rise, glaciers and polar ice caps melt, causing sea levels to rise. This can result in coastal flooding, erosion, and damage to infrastructure and property. Changes in temperature and precipitation. Climate change can alter temperature and precipitation patterns, leading to changes in growing seasons, crop yields, and water availability. Health impacts. Climate change can lead to increased exposure to air pollution, heat stress, and waterborne diseases affecting human health. Economic impacts. Climate change can result in lost productivity, damage to infrastructure and property, and increased costs for mitigation and adaptation measures. To manage climate change risks, individuals, organizations, and governments can take a range of measures, such as reducing greenhouse gas emissions, investing in renewable energy, improving infrastructure, and promoting sustainable land use practices. Adapting to the effects of climate change, such as sea level rise and extreme weather events, is also important. In summary, climate change risks refer to the potential harm or damage caused by the effects of global warming and the resulting changes in climate patterns. These risks can affect individuals, organizations, and communities, and can result in environmental, social, and economic impacts. To manage climate change risks, individuals, organizations, and governments can take measures to reduce greenhouse gas emissions, invest in renewable energy, improve infrastructure, and promote sustainable land use practices. Adjusting to the effects of climate change is also important. Pandemic risks. Pandemic risks refer to the potential harm or damage caused by the outbreak of a contagious disease that spreads rapidly and affects a large number of people globally. The recent COVID-19 pandemic is a clear example of how a pandemic can cause significant harm and disruption to individuals, organizations, and societies. Health impacts. Pandemics can cause significant health impacts, including illness, hospitalization, and death. The severity of the health impacts depends on the characteristics of the disease and the effectiveness of public health measures to control its spread. Economic impacts. Pandemics can disrupt supply chains, reduce consumer demand, and lead to job losses and business closures, resulting in significant economic impacts. Social impacts. Pandemics can lead to social isolation, anxiety, and other mental health impacts, particularly for vulnerable populations such as the elderly, low-income individuals, and those with pre-existing health conditions. Disruption of essential services. Pandemics can disrupt essential services such as healthcare, transportation, and food supply chains, causing additional harm to individuals and communities. To manage pandemic risks, individuals, organizations, and governments can take a range of measures, such as promoting public health measures, such as social distancing and vaccination, investing in healthcare infrastructure and capacity, and implementing effective crisis management plans. Pandemic risk management requires a coordinated approach among multiple stakeholders, including public health authorities, healthcare providers, businesses, and individuals. Pandemic risks refer to the potential harm or damage caused by the outbreak of a contagious disease that spreads rapidly and affects a large number of people globally. These risks can result in significant health, economic, and social impacts, as well as disrupt essential services. To manage pandemic risks, individuals, organizations, and governments can take measures to promote public health measures, invest in healthcare infrastructure, and implement effective crisis management plans. Pandemic risk management requires a coordinated approach among multiple stakeholders. Artificial intelligence risks. Artificial intelligence, AI risks refer to the potential harm or damage caused by the use of AI technologies, including machine learning algorithms and other forms of automated decision-making. As AI systems become increasingly integrated into our lives and society, there are growing concerns about their potential risks. Bias and discrimination. AI systems can perpetuate or even amplify existing biases and discrimination, particularly if they are trained on biased data. This can lead to unfair or discriminatory outcomes in areas such as hiring, lending, and law enforcement. Safety risks. AI systems can pose safety risks if they malfunction or make incorrect decisions. For example, a self-driving car that is not properly programmed could cause an accident. Privacy and security risks. AI systems can collect and process large amounts of personal data, raising concerns about privacy and security. If AI systems are hacked or misused, they could expose sensitive information. Accountability and transparency. AI systems can be difficult to understand and explain, making it challenging to hold them accountable for their decisions. This lack of transparency can also make it difficult to detect and address any errors or biases. To manage AI risks, individuals, organizations, and governments can take a range of measures, such as implementing ethical AI principles and standards, promoting transparency and accountability in AI decision-making, and investing in AI safety and security measures. AI risk management requires a coordinated approach among multiple stakeholders, including AI developers, regulators, and users. In summary, AI risks refer to the potential harm or damage caused by the use of AI technologies, including bias and discrimination, safety risks, privacy and security risks, and accountability and transparency challenges. To manage AI risks, individuals, organizations, and governments can take measures to implement ethical AI principles, promote transparency and accountability in AI decision-making, and invest in AI safety and security measures. AI risk management requires a coordinated approach among multiple stakeholders. Ethical considerations in risk management and insurance. Ethical considerations are an important aspect of risk management and insurance. When dealing with people's lives, health, and property, it is essential to act ethically and with integrity. Confidentiality. Insurance professionals are often privy to sensitive personal information. They must respect their clients' privacy and keep their information confidential. Fairness and non-discrimination. Insurance companies and agents must not discriminate against individuals based on factors such as race, gender, religion, or sexual orientation. They must treat all clients fairly and provide equal access to insurance coverage. Transparency. Insurance companies must be transparent about their policies and coverage, and insurance professionals must provide clear explanations of policy terms and conditions to their clients. Honesty and integrity. Insurance professionals must act honestly and with integrity in all their dealings with clients. They must not misrepresent policies, coverage, or pricing, and they must disclose any conflicts of interest. Responsibility. Insurance companies and agents have a responsibility to ensure that their policies are appropriate for their clients' needs and that they provide adequate coverage. Social responsibility. Insurance companies can play a role in promoting social and environmental responsibility by offering policies that incentivize sustainable practices or support social causes. Professionalism. Insurance professionals should adhere to professional standards and ethical codes of conduct. Ethical considerations are an important aspect of risk management and insurance. Insurance professionals must act with integrity, respect their clients' privacy, treat all clients fairly, be transparent, act with honesty and integrity, take responsibility for their policies, promote social responsibility, and adhere to professional standards. Doing so, they can build trust with their clients and promote the long-term sustainability of the insurance industry. Professional standards in risk management and insurance. Professional standards are essential in the risk management and insurance industry to ensure the protection of consumers and promote ethical behavior among professionals. Licensing. In many countries, insurance professionals are required to obtain a license to practice. This process typically involves completing a pre-licensing education program, passing an exam, and meeting ongoing continuing education requirements. Ethics. Professional organizations, such as the Chartered Insurance Institute, CII, have established codes of ethics that their members must follow. These codes typically include standards related to confidentiality, conflict of interest, and treating clients fairly. Continuing education. Many professional organizations require their members to complete ongoing education to maintain their license and stay current on industry developments. Standards of practice. Professional organizations also establish standards of practice that their members must adhere to. These standards may include best practices for risk assessment, risk mitigation, and claims handling. Regulatory compliance. Insurance professionals must comply with various regulations governing the industry, including those related to consumer protection, privacy, and data security. Industry certifications. In addition to licensing, many insurance professionals seek industry certifications, such as the Certified Insurance Counselor, CIC, or the Chartered Property Casualty Underwriter, CPCU. These certifications demonstrate a higher level of expertise in specific areas of the industry. Adhering to these professional standards, insurance professionals can build trust with their clients, promote ethical behavior within the industry, and contribute to the long-term sustainability of the industry. International insurance market. The international insurance market is a vast and complex industry that spans the globe. It includes insurers, reinsurers, brokers, and other service providers that operate in multiple countries and jurisdictions. Globalization. The international insurance market has become increasingly globalized over the past few decades. Large multinational insurers now operate in dozens of countries, offering a wide range of products and services. Regulation. The regulation of the international insurance market is complex and varies by country and jurisdiction. Many countries have their own regulatory bodies that oversee insurance companies and brokers operating within their borders. Reinsurance. Reinsurance is an important part of the international insurance market. Reinsurers provide insurance to insurance companies, helping them manage their risks and protect their policyholders. Emerging markets. The international insurance market is seeing significant growth in emerging markets such as China, India, and Brazil. These markets offer vast untapped potential for insurers and other service providers. Risk management. The international insurance market plays a critical role in global risk management. Insurers and reinsurers help businesses and governments manage risks related to natural disasters, political instability, cyber attacks, and other threats. Innovation. The international insurance market is constantly evolving and innovating. Insurers and other service providers are investing in new technologies, such as artificial intelligence, blockchain, and the Internet of Things, to improve their products and services. The international insurance market is a dynamic and vital industry that plays a critical role in protecting individuals, businesses, and economies from risk. As the world becomes increasingly interconnected, the importance of the international insurance market will only continue to grow. International regulations and standards. The international insurance market is subject to a variety of regulations and standards that are designed to protect consumers, ensure the financial stability of insurers, and promote fair competition. Solvency II. Solvency II is a set of regulations that governs the solvency and capital requirements of insurance companies operating in the European Union. The regulations require insurers to maintain sufficient capital to cover their risks and ensure that policyholders are protected in the event of insolvency. International Financial Reporting Standards, IFRS. IFRS is a set of accounting standards that is used by many insurance companies around the world. The standards provide a common framework for financial reporting, which helps investors and regulators better understand the financial health of insurers. International Association of Insurance Supervisors, IAIS. The IAIS is an international organization that promotes effective supervision of the insurance industry. It develops and promotes standards and principles for insurance supervision and provides a forum for regulators and industry stakeholders to exchange information and best practices. Insurance Core Principles, ICPs. The ICPs are a set of standards developed by the IAIS that cover all aspects of insurance supervision, including solvency, market conduct, and consumer protection. The principles are designed to promote sound and effective regulation of the insurance industry. Basel III. While not specific to the insurance industry, the Basel III regulations are important for insurers as they set standards for the amount and quality of capital that banks and other financial institutions must hold. These standards are important for insurers as they often invest in banks and other financial institutions and rely on these investments to generate returns for policyholders. Anti-money laundering, AML, regulations. AML regulations are designed to prevent money laundering and the financing of terrorism. Many international insurance companies are subject to AML regulations, which require them to implement controls to prevent these activities. International regulations and standards play an important role in ensuring that the international insurance market operates in a safe and efficient manner and provides adequate protection for policyholders. Insurers and other industry stakeholders must stay up to date on these regulations and standards to ensure compliance and maintain the trust of consumers and regulators.